I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here. Great to have you.
Well, thank you, Charlotte. Great to see you again.
Really good to be speaking with you. And of course, our last conversation was in March back at PDAC. And really quite a bit has changed for the gold price since then. So I was going to start nice or I think it's simple. We'll see. What do you consider the drivers of that price increase? I've gotten a lot of different answers from people.
Really? I thought it was pretty obvious, but maybe everybody else thinks it's pretty obvious. I was about to say we all know, but if you've got different answers, we don't all know. It seems to me that the main driver by far has been central bank buying. That's been the main driver, and of the central bank buying up until the last 2 months, it's been China. China has been the main buyer of gold, but even when China's paused, both in May and June, so they bought no gold in May and June, other countries were still buying. So central bank buying has been the main driver, not just this year, but for the last 18 months, really. The second major factor of in the buying has frankly just been Chinese investors. And these are people who are afraid of their banking system. They're nervous about a Chinese economy, a stimulus coming in, and they're nervous, frankly, about the possibility of a yuan devaluation. I don't think that's going to happen, but so they don't want money in the banking system, which they're nervous about. They don't want to put money in real estate, which, of course, is a traditional haven for Chinese, but for obvious reasons, because half the Chinese real estate companies are going bankrupt. They're not allowed to buy crypto, and so that leaves gold, which, of course, Chinese people like anyway. I mean, we're painting with a very broad brush here, but, you know, this is not a stretch for Chinese savers to invest in gold. And you can see that if you look at the numbers from the Shanghai Gold and Silver Gold Exchange, the withdrawals from the Shanghai Exchange, but also from the imports into Hong Kong. These are numbers that are reported. So you can see that. So that's a very large driver. Offsetting that, of course, is the fact that ETFs, and we might talk about this later, but gold ETFs, other than Asian ETFs, but North American and European gold bullion ETFs have had withdrawals, and pretty steady withdrawals all year, which is really, in a way, astonishing, but we can talk about that if you want. So offsetting that. So when you look at the numbers and add them all up, there's still a gap. You know, who else? Someone else is buying. And the buying, I think, is coming from sophisticated, if you like, wealthy individuals and families in the Middle East, in Asia, but also to some extent in North America and Europe. And that buying is physical, over-the-counter, so it's not, each trade is not reported, but in aggregate you can see that's a pretty big number. And I think the interesting thing to me is that everybody's buying, the buyers, the central banks, the Chinese, the wealthy individuals, put them into buckets, they're buying for reasons that have nothing much to do with the macroeconomic environment, which is, high inflation, high interest rates, strong dollar, relatively low and declining inflation, apparently. I mean, I'm not saying I agree with these narratives, but this is what the headlines would tell us. A strong stock market, which is competition for gold, and I said a strong dollar, didn't I? So those factors are typically a bad economic environment for gold. And I think that's why individuals in the US are pulling money out of gold ETFs, why investors in Europe are pulling money out of ETFs. But the people that are buying for reasons other than the macroeconomic environment. Central banks, of course, are buying because of a weaponization of the dollar. Chinese buyers we've already talked about. And the sort of third group, what I'm calling the wealthy, insightful, I think they're buying not because of a macroeconomic environment, because they're worried about the fragility of the system. They're worried about something much, much bigger than, whether we're going to have a recession or rates are going to go down or inflation is going to go up.
Okay. So, yeah. So, okay. A lot of dynamics there going on and a lot of points to follow up on. So starting with central banks. So you mentioned right at the beginning of your answer there about China hasn't added to its reserves in the past couple of months. People seem to be a little bit nervous about that. For you, what does that mean? Are you worried?
Well, first of all, I don't think, I really didn't think, and I had said this in some interviews earlier in the year, I honestly didn't think, I wasn't surprised that China decided to pause. You know, we've had the gold price go from, they started buying when gold was a little under, recent buying, little under 2,000, and they were buying all the way up to 2,300. Not a surprise that they decided to just stand back and let things settle down. I'm not concerned as it affects China per se. The concern for me is that if China stops for 2 or 3 months, do other central banks follow them? Now, in May, when the numbers came out, we saw lots of central banks buying gold, no impact. But of course, at that time, Turkey and Venezuela and Saudi Arabia, they didn't know that China wasn't buying. So now we haven't got the full numbers for June yet. I think that'll be important to see, are other central banks still buying? So that, to me, if China stops buying for, let's say, 6 months, then the risk is that other central banks decide, well, let's just also hold back and wait for lower prices because they know something we don't.
Okay, so we'll wait and see on that. We'll keep a lookout for those June numbers. Let's go back also to the ETF outflows, because that sounded quite interesting as well. So ETF outflows, I think you said we're seeing that pretty much everywhere except for from the Eastern markets. So anything you would add on that point that investors should be aware of how that's influencing the gold price?
Yeah. And the Eastern, I mean, on balance, all ETFs are getting outflows, but the Eastern ones are getting inflows, but the net, it's still outflows. I think, frankly, it's a matter of the macroeconomic environment. Which investors in the U.S., whether they're small institutions, whether they're individuals, family offices, this just does not seem like the good environment to be buying gold. And the stock market is still doing well. Now, you and I think everybody and his dog knows that NVIDIA is driving 50% of the stock market this year, and we know that 4 or 5 stocks are driving 70% of the S&P this year. This is not a healthy market. This is the worst market breadth I have ever seen. You've got a market high, and you've got more individual stocks making 52-week lows than 52-week highs. That's a very, very worrying sign. But nonetheless, the market is going up. So why do I need gold? I think that's the narrative.
Right, and going back to our last interview in March, you said the slowing economy in the U.S. was getting too hard to ignore. And if you were still believing in a soft landing, that's like believing in the tooth fairy, right? So I've definitely, since last week's jobs data, started to see headlines about weakness in the economy. So what cracks are you watching most closely right now? And do you feel that more people are now getting that?
I think it's getting there, and it's getting there slowly. It's not surprising that it's taking a long time for a recession to occur when you think that we've really had 12 years of excessively easy money and low interest rates, and 3 years, well, the 2 years of COVID, with just unbelievably excessive, an abundance of money thrown into the economy. And so it's natural that therefore it takes longer for all of that to weed out of the economy till we get to a recession. I think there's 2 things. One is the employment that you mentioned, and the headline numbers like new jobs creation and like job layoffs and new unemployment claims and the unemployment number itself. They are just inching towards the direction of recession. But the reality is that I think those numbers in many ways are flawed. And if you look under the hood, the employment picture is a lot worse than the new jobs creation and the unemployment rate would suggest. I mean, first of all, new jobs creation, you've got 2 reports, both from Bureau of Labor Statistics, 2 reports, the payrolls report and the household survey, which are going in diametrically opposite directions. And even the Bureau of Labor Statistics, this is not, an independent, it's certainly not sort of Adrian Day. The Bureau of Labor Statistics itself is showing a loss of over 1 million full-time private sector jobs last year. That is private sector. I mean, the government is still the main driver of new jobs. That is not a healthy jobs picture. Same with consumer spending. Consumer spending is still strong, apparently. Slowed a little bit. That's what I mean by headline is inching. But look at credit card debt. Look at buy now, pay later. Look at those numbers, and People, a lot of consumers are not buying things out of income. They're buying things through debt, and that cannot go on forever. Now you're starting to see credit card companies, not just Discover and Capital One, which tend to serve the lower market, but now you're seeing Chase and other companies like that start to cut credit lines on credit cards and actually do defaults on some of his debt. Those numbers are going up. So again, those are very, very worrying signs. And you could look at different sectors, different areas of the economy, manufacturing and so on, and see the same kind of the same worrying signs under the hood.
I think this is helpful context because before we came to this event, we asked our audience, what topics do you want to see covered? What questions do you have? And one of the ones that came up was, we're hearing about this hard landing, but when is it actually going to get here? So it will take some time.
Right. No, absolutely. Well, I know we talked about this in March. I'm sure we did. The average length of time from the first rate hike to the onset of a recession, going back to the 1960s, has been almost 50 months. And one of those was an outlier. So take the outlier away, which, I'm trying to be as on the other side as devil's advocate as I can be. Take the outlier away. You'll still look at an average of 27 months from the onset of the first rate hike to the onset of a recession. So when was the first rate hike in the U.S.? It was it April of 21?
You would remember better than I would.
So, 22, sorry. And so we're only just at 27 months right now. We're only just at what is the average period of time. When you consider that we had, as I say, 12 years of excessively easy money and low interest rates, which meant that households as well as corporations were able to refinance at lower rates, term out their debt longer, etc., it's not surprising that it's taking a long time for that recession to happen. Just to give a simple example to put it in, I like to always look at, anecdotes. The household that bought a second-hand car, 7 or 8 years ago, they probably financed at LIBOR plus 5. So they were paying 7%. That clunker is now dead, and they need to buy a new car. They're not paying 7% now. They're paying LIBOR plus 5. They're paying 10%. So you look at a corporation that borrowed money 5 years ago when rates were 2.5% or less than 2.5%. And again, the same thing. If their 5-year notes or 5-year bonds come due next year, for the last 5 years, they've been fine. They've got debt on the balance sheet. They paid 2.5%, 3%, 4% for it, LIBOR plus 2 or whatever, and everything's fine. But suddenly they have to refinance and roll over that debt, and you go from whatever it was, 4% to 8%. Huge increases.
Okay, really good overview, and sorry to make you go through a topic again that I think we have covered before, but I think clearly it's something that people wonder about. Okay, so where's the Fed in all of this? We've seen interest rate cut expectations change quite a bit over the course of the year. So what are your thoughts on how this pans out in 2024?
Yeah, no, that's a really good question and a really interesting question. I'll be honest. First of all, I was not one of those who last year and the year before, thought the Fed was going to start, pivoting early. I wasn't expecting that, but I really was expecting rate cuts this year. I really was. I thought we would have had them by now, either March or June. I think the reality is that the Federal Reserve is in and knows it is in a no-win situation. They really are facing a no-win situation. Now, I'm not blaming Jerome Powell, but I will blame the Fed. This is a problem of the Fed's own creation. But nonetheless, where we are right now, if they start cutting rates right now, that is really going to, boost inflation, and Powell definitely doesn't want to do that. He does not want to be remembered as the Fed that turned too soon before the job of killing inflation was accomplished. See, we know this. He's concerned about his legacy. Now, on the other hand, keeping rates, even if you don't increase rates from here, and I don't think there's much prospect of that, but even if you keep rates where they are for a long period of time, you are as every month goes by, as I say, as every month goes by, more households go from the low interest rate car loan to the higher interest. More corporations go from the low loan to the higher loan, etc. The longer you keep it on, the more individual households and corporations get into problems, and therefore the more the economy starts getting into problems. The more you risk higher unemployment. And the other thing we haven't talked about, but I'm sure some of your other guests has, of course, is the payment on the federal debt. Again, if the average payment on the federal debt as of last month, 3.3%, according to Brian London, and I'm sure he got it from somewhere, 3.3%. That's well below what you can finance, what the Treasury can finance for now, whether it's 1 month or 30 years. They can't finance for 3.3. You look at the 5-year notes that were issued in 2019, 2020, they were paying less than 2.5%. They come due at the end of this year or beginning of next year, they have to refinance at 5%. There's no way around that. And and we know that the Treasury issuance is increasing, and we know that the potential buyers of Treasuries, the traditional large buyers of Treasuries, like China, like Japan. Japan's still a big buyer, but I think, it's going to decline as their interest rates move up and their yen moves up with it. More Japanese money will come back into their own domestic bond market. Regional banks are worried about buying Treasuries, and the Fed is not supposed to be buying Treasuries. They're supposed to be selling their Treasuries. So the traditional buyers of Treasuries are not buying, and yet the issuance is going up. The market's going to start demanding higher rates pretty soon. And so the longer the Fed keeps rates where they are, the more we risk financial, a crisis with the federal government, payment of debt, and a recession. Unfortunately, I think the answer is going to be that the Fed is going to start monetizing the debt again. So they may cut rates to help the economy, but monetize the debt to help out the Federal Reserve. And that's going to be a very serious, very dangerous situation. Just, not solving anything. Okay. Sorry. No. So the answer is I really don't know. I still think they're going to cut rates, but the problem now is if they don't cut rates this month, they're meeting this month, there's no meeting in August, you're getting very, very close to the election. And whatever Jerome Powell says, the Fed knows full well when the election is, and they do not want to be seen as interfering in the election. To cut rates in September or October, right before the election, I think would be exceptionally controversial.
Interesting. And just another small point on Powell's legacy and the election. How long does he possibly have to finish creating his legacy, considering, changes that may happen?
No, that's a good question. I'm not sure what to... sorry, I should know, but I don't know. I don't know what the term fair. Is. I suspect that Trump would not want to reappoint him, but I also suspect that Powell would not want to be reappointed under Trump. So, whatever his term is. And if he can go out... he's thinking of his legacy primarily from the point of view of inflation. If he can go out with inflation low, even if we're on the precipice of a more serious recession than we would have had, he's probably comfortable with that.
Okay, interesting. Okay, so we'll watch and see what happens with that one. I think going back to gold as we kind of come toward the end here. So gold, the price is of course historically high, but I think investors still remain disappointed about the performance of the gold equities.
Yeah.
So thoughts on that? Are they performing as you would want them to? And when may they catch up to the degree that people might want?
As I would want them to, or as I
maybe as you would
expect is different. We're never satisfied, right? And particularly, this is an interesting point. Gold investors are never satisfied. Look at the XAU of a GDX. From the bottom in March to the beginning of June, they were up 40%. 40% in 3 months. There's nothing wrong with that. Yet everyone's complaining about the gold stocks not moving. Now, of course, a lot of the juniors are not moving, and the seniors have given some of the seniors have given some of that back. In June. I think it goes back to much the same sort of analysis that we had with physical gold, which is that the macro environment for gold stocks is not really positive. Yes, the gold price is high, which is obviously a big factor. The margins are very strong, which is obviously a big factor. But the broad stock market is doing well, and typically gold stocks do better when the broad market is rolling over or stumbling or whatever word you want to use, not necessarily crashing. And again, the dollar's strong and inflation's low, so this is not the sort of environment where everyone's saying, I need to buy gold stocks. It is surprising to me. It is surprising to me that we are continuing to see outflows from the gold mining ETFs and the gold mining mutual funds. That is very surprising to me, but we're continuing to get that outflows. Part of it, I think, might be because a lot of people in the economy are actually beginning to suffer. So they're pulling money out, not because they think gold stocks are going down, but because they need the money. I can frankly see that, it's always a good barometer in my own money management when people who've never had withdrawals before ask for $10,000 out of $1 million account. There's something going on there, right? And we saw this a lot in 2008, 2009, incidentally. But anyway, to get back to so what I'm looking at right now is I think we have, I won't say this time is different, that's dangerous. I think we have an exceptionally rare and very, very attractive opportunity in the gold stocks. And I'll tell you why. Number one, they're extremely undervalued. And they were in March, and they are now. Agnico Eagle, the third largest gold mining company in the world, with no particular hairs on it, good jurisdictions, good balance sheet, good management, blah, blah, blah. No particular hairs on it, and yet it is selling at very, very close to its 40-year low price to cash flow. Ridiculous when the price of gold is where it is and where the margins are where they are. So number one, they're very cheap, and we could go through other stocks with different metrics. Number two, they're selling at lower multiples than the S&P, which is unusual. The XAU in aggregate has a stronger balance sheet than the S&P, has a higher dividend yield, is selling at a lower price to book value and a lower price to cash flow. That's very unusual. So gold stocks are cheap or undervalued. Then you've got a very favorable environment in terms of a high gold price and high margins. Think about in the first quarter, most gold, well, all of them really, reported good cash flow numbers. The average selling price for gold in the first quarter was $2,070. The average price in the second quarter is $250 more than that. And what's happened to costs between the first quarter and the second quarter? If anything, a little bit up. The oil price marginally up on average, just marginally, a dollar or two. And other things, actually, it seems as though the companies are getting their costs under control. So in other words, we should have much larger, much wider margins in the second quarter than we do in the first quarter. So I think when the companies start to report their second quarter earnings later this month, we're going to start to see some very attractive cash flow numbers, better than the first quarter and better than the year-ago comparisons. I've got to think that investors, when they see 2 back-to-back quarters of strong cash flow numbers, are going to start to look at these companies. And just to finish, if I may, what makes this a particularly attractive opportunity right now but will not last is that typically when gold assets take off, gold starts to move, and then the gold stocks outperform dramatically in the short term. 2001, for example, first 3 months, gold was up 12%. Very respectable. Gold stocks were up 50% in the same period. We could look at 1976, we could look at 2009. That's the typical kind of scenario. Gold stocks were up 50% in 3 months in 2009. Look at where we are now. Over the last 12 months, gold is up 25%. Gold stocks are up 25%. Look at this year. Gold is up 16.5%. Gold stocks are up 17.5%. Very close. You have not had that normal leverage. So the point I'm making is people are able to buy gold stocks when the gold price is high, when the environment is strong, when the outlook is very good, and when gold stocks have not yet shown that typical leverage that they show at the beginning of a market.
Okay. I think that is a great place to wrap up. And I will say, I think that may be the most emphatic that I've ever heard you make that point.
Well, I am English, remember?
That's true. But this is really good. Thank you so much for taking the time to explain market dynamics and the opportunity.
Thank you very much for having me, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Adrian Day. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.